Hi everyone, welcome back to our coverage from the Capital HQ Annual Investor Day here in Sydney. I'm joined now by Ben Goulet, the Executive Director and Head of Capital Markets at Kraft. That's Commodities, Receivables and Finance Trust. Now, if you're a sophisticated investor who's been looking at the private credit market, you've probably noticed that there's no shortage of opportunities that are promising high returns. But Kraft is taking a very different approach. They're actually offering 8% fixed returns, not targeted but fixed, backed by commodity supply chain finance, which historically was one of the lowest default rates in all of credit markets. So, we are going to unpack what that actually means and why it matters. Ben, thanks for joining me.
Thanks, Rizm. Great to be here.
So, Ben, let's start here. So, you are offering 8% fixed, and you are explicitly saying that you're not trying to shoot the lights out with aggressive return targets, which is very unusual in today's market. So, why lead with that message? Why not chase higher yields?
So, we're offering a genuine premium risk adjusted return over our underlying risk. We've decided to focus on the safest part of the private credit market, which is commodity finance facilities. So, we don't chase yield.
Yeah.
We want to offer a stable, predictable income opportunity for private investors that offers a genuine risk adjusted return over the
Yeah.
underlying risk.
Now, COVID was a masterclass in finding out what actually works when everything breaks. So, COVID was a stress test for everyone. We had property funds gated redemptions, suspended distributions. But you mentioned commodity finance default stayed below 0.1% in your segment. So, while real estate debt hit 9%, so what made commodity finance so resilient?
The ultimate test was COVID and the GFC, of course. And what it showed is that this segment of the finance market continues to perform. It's because of the nature of the lending. It's highly contracted, fixed pricing, and continues to flow. Commodities underpin societies, and regardless of economic outcomes, commodities continue to flow.
Correct.
We specifically target the tier 1 and tier 2 counterparties in this space in OECD markets only. So we're talking about the top borrowers in this segment. So when you look at those default rates, they are for the entire market of trade finance,
Right.
which includes tier 3, 4 and beyond.
Yeah.
So we really only target the top best of the best borrowers in the best markets. And that's why we offer a genuine risk-adjusted return on our 8%.
So, when you are lending against the tier 1 commodity supply chains, what does that actually look like? So, could you give us a real example of a typical Kraft transaction? What are you financing? Who's the borrower? And what's the collateral?
Sure. So I can't mention names, of course. It's a
Yeah.
highly confidential space. But think of a fully laden coal shipment ex-Eastern Seaboard of Australia with an Asian trading house counterparty and or an Asian end user, be it power station or utility or steel manufacturing. Our security is directly over the cargo of the shipment. The counterparties are all known. The facilities are often recurrent facilities, so they're repeatable. And if anything goes wrong, we take security and we take ownership directly over that cargo.
Right.
And we're out, if there's any problem with any of the balance sheets in that ecosystem,
Yeah.
we're out before the on-balance sheet lenders even know there's a problem because we have security over those shipments.
Right. Now, Ben, if something goes wrong, how is liquidating commodities different from selling an illiquid building?
So commodities have daily pricing, and our commodities that we deal in are highly contracted and fixed priced, in fact. So we don't have to undertake price discovery. When things go wrong in the economy, as we know, real estate transactions, as an example, are sticky, and price discovery can take months. And when things go really bad, funds gate, people's equity are tied up, whilst there's a workout scenario. We have daily markets and we can liquidate positions immediately.
Now, Ben, let's talk about your team advantage. So, your team has a pretty unique profile. So, for our investors, I'll share. Tim was a CFO at multiple mining and resource companies. Stuart has 30 years in logistics and supply chain management. You've got Kai, who literally moves 6 million tons of commodities annually through NEPA shipping. David spent decades at BHP, Anglo American, Glencore. So, this isn't typical for lending business. So, why does that operational and logistics experience matter for what is essentially a credit decision?
That's a very good question. So it's not just important to understand the contracting and the balance sheets in our counterparties. We need to deeply understand the supply chain. This really is a logistics funding business. We don't take balance sheet risk. We need to know where the cargoes are at any one moment at time. And so we need that deep understanding across not just capital markets,
Correct.
not just lending, but also supply chains. So
Yeah.
we bring together a group of experts in their fields that bring together over 200 years of professional expertise,
Yeah.
everything from corporate finance back to shipping and logistics.
Ben, you've said something interesting here that, we track the cargo and not just the contract. So what does that actually mean in practice?
So we have in our systems, we know which ships have which
Yeah.
cargoes at any one time. And so
Okay.
we know when it lands, we know when the testing's done at the other end on the cargoes. So
Okay.
we're highly plugged into the entire ecosystem. We know exactly what's going on with our facilities and the underlying all the time.
Yeah.
And that's why it's such a low risk opportunity.
Yeah.
And again, these facilities are repeatable, commodities trade daily and all the time. Our businesses are with customers we've known for a long time as well. So we know.
Ben, banks are pulling back from commodity finance, and that's creating this gap that you are filling. And here's a question that every investor is thinking, that if this is such good credit with such low default rates, why aren't the banks fighting to stay in this business? What's really going on? Can you help me understand the dynamics?
Yeah, it's a great question, and I've had it often today in between the conference. So banks basically withdrew from this space because of ESG mandates. So you've got banks that are controlled, majority controlled, or at least sentiment controlled by the superannuation industry in Australia, which is very ESG conscious and often has very black and white mandates around extraction. These counterparties have been debanked by the major banks. It was the lowest risk, highest margin lending these banks undertook, but due to ESG and also regulatory capital requirements, it became unprofitable and not feasible for them to continue in this space. We see no problem chasing down over $20 billion of demand in our tier one market segment. We're only limited by how fast we can credibly underwrite the facilities underneath. And we can put away up to $200 million a quarter in our space.
So, Ben, you've mentioned a $20 billion addressable market in your target segment. What does scaled success look like for Craft? Like, where do you see this in the next 2 to 3 years?
Yeah, look, we see ourselves as a leading private credit provider to this commodity finance space. Our first note issuance is an 8% coupon. We are going to go back to market when we fill that first issuance with a lower cost of capital. As we get scale, we will have a rated version of the note, and then we'll be tapping into global bond markets, so wholesale funding. So we'll see our cost of capital coming down. Our first issuance is a real opportunity for private investors to get a genuine risk-adjusted return on the risk that is underlying the fund.
Ben, you're already operational, you're generating returns, and you've got your first semi-annual interest payment coming up on the 30th of September. So for investors watching this who want to learn more, what's the process? How can they get involved?
Yeah, great. Good question. So we launched in March of this year, and our initial note holders got paid today, their initial coupon. So we're live and our fund is operational. If they want to get involved, they just have to email and get in contact. We have a deal room set up on Capital HQ. And so we can reach out via that platform, which is very efficient, or email is fine. Equity Trustees is our independent note trustee and security trustee, and we can take the onboarding directly via them. So.
Oh, that's truly wonderful, Ben. Now, for our viewers watching, that was Ben representing Craft. And as Ben mentioned, the details are going to be available to the Capital HQ deal room at the side of the screen or in the description of this video. So please feel free to connect with the team at Craft. And once again, thank you, Ben, for being here today and sharing your wonderful insights with the work that you and your team are doing.
Thanks, Rhythm.